Today, we're going to talk about an overview of financial modeling, and I'm going to use my favorite tool, which is ProformaPlus. So if we pop in to the first screen, which is the Project Center on the first tab, you'll see that it gives me this wide array of information, and it is segmented into investor returns, construction loan, mortgage, senior debt, preferred equity if you use it, common equity. It even gives you the opportunity to insert hurdles if you are working on an investor sponsor promote. And ultimately, it has a financial performance summary followed by cost recovery upon sale. And then you can insert different capitalization rates in this particular model. Now, all of those are essential for doing a financial model, whether you're doing a single-use build-to-suit or whether you're doing a 400-unit apartment complex with a complex rent roll structure. But the thing that I like most about this particular system is that it sequentially goes down the steps that you should take. So as we start, I always start with my setup screen, and this screen will allow you to enter all of your project information down to the development company, the location of it, the size, the project type, what class A, B, or C it is, any kind of waterfall settings that you may or may not have. It also allows you to enter your tax rates, both personally and if you want to figure your cap gains on exit, it allows you to do that. It also allows you to have a project timeline. When do you anticipate to start? And when are you going to put it in service if it's got a construction or a value add component? And what is your anticipated sale date? That's always important in a financial model because you're working backwards into an internal rate of return over how many years that you hold it. You also have the opportunity to insert and manipulate operating assumptions. That would be vacancy and credit loss, rental income and escalation rates, and operating expense escalation rates, all as a percentage. Now, it's important to put these in because with inflation the way it is right now at around 3.8 to 5%, you're going to want to manipulate these because you know your expenses and possibly your revenue is going to increase over time. As we step down, your next tab is entering your land and your land purchase. I won't go into the details here, but this particular page in the financial model overview allows you to enter your specific parcel, the amount of square foot, and the purchase price of that, and then you attach it to this particular financial model program. The next step is entering your first pass at your building income. A lot of times I'll come back to this page because I want to get to a certain rate of return that is my personal profile. But I've entered here some specifics here to start off with before I start doing any sensitivity analysis. Right now, I've determined that this particular project at 21,000 square feet will rent at approximately $34 grossed up per square foot, which gives me $756,000 a year. This is a single use, so it's quite easy to back into a number. I'll come back and visit that after I have input all the other data that's essential. Some of those essential items are development cost. You'll see here, again, we've sequentially lined it up in the order that you would acquire or develop it. So I start with my acquisition cost, which is loaded from your land input, and then I start to enter my detailed construction cost to the degree that I have it. On this particular project, I have everything from earthwork to electrical, and I have everything in between. So I just go down, I start entering my costs line item by line item, and every time I make an entry, it uploads here into construction costs on the right-hand side. So this is a very fluid running total of how much money I'm investing into the project. I'll do the same thing for site development. i.e. utilities or paving, landscape and irrigation. And then I'll insert my soft costs, which are architectural engineering, civil engineering, landscape architect, materials testing, and so forth. And then there's always going to be fees that I have to pay, like traffic impact fee, building permit fee, or in this case, a special consultant fee. The last thing I'll do here is if I'm doing an interior remodel or interior fit out, I will, again, as much detail as I have, I will insert those costs here. The next step in the financial model is called the capital stack. Now, most projects that people view on this channel, they're going to have one loan or two if you have a construction and a permanent. So I won't go into detail on mezzanine debt or preferred equity as much today. But again, this particular software has the ability to enter all of your capital stack along the way. So if I tab on senior debt, this is a ground up project that we're going to build. So it's already calculated and ported over my construction cost. I simply enter my loan to cost ratio and my interest rate, my term of my months that I'm going to be under construction, and it will figure my construction interest carry. And then I come over here and I enter my interest rate for my permanent mortgage, what my term is, in this case it's 7 years, what the amortization period is, and if there are any points, and of course 12 payments per year in most cases. Again, I will come down here and I will calculate and save, and it will recirculate all the calculations and determine what my interest carry is both in construction and long-term financing. What I love about this is it also gives an opportunity to really pinpoint your construction via your construction draws. Now, this is a 12-month project, so in this particular case, it's similar to a bell curve as a percentage of completion each month. Usually, the majority of your cost comes in the middle when you have steel delivery or a lot of concrete. So you can see here it starts off at 8%, it goes up to 12%, and then it goes back down to 3% at the very end. This is very important because ultimately, I'll show you in the construction loan analysis, this is the bell curve here, but it's important that I try to pinpoint how much interest carry I'm going to have. If there's one thing that a lot of my developer friends don't do is that they don't calculate this appropriately. This gives no room for error if your percentage of construction each month is correct. So after my capital stack, I have my operating costs. If this is a triple net facility, which means that my tenant is going to pay all costs and he's just going to write me a check every month, I'm not going to have insurance or property tax or those sort of things. But in this particular annual operating cost section, this is where you would place all those management fees, facility fees, taxes and insurance, and your utility costs. When I use this, if I were to enter utility costs, this would actually enter an amount and then divide it by 12, and it will set it up per year. Remember, you have the opportunity to also plug in an escalation because typically operating expenses always tend to rise year over year. The last few things that I do is I have an other income and expense. In the case of a multifamily, if you've got supplemental income by parking garage or extra storage facilities or what we call RUBS in the industry with multifamily, you would be able to enter that into this other income and expense. Finally, if the bank requires you to have some form of funded reserve for future to make sure that you allocate properly, let's say it's a multifamily and they want you to have $20 a month per door, this is where you would input that. It would port it into the system and ultimately it would go back up to the project center and enter it as an additional expense. It's not capitalized, but it's a funded reserve. And then at the end, after I've entered all that, I'm going to go back up to the project center. And this is where I could start manipulating my rent, and I could start manipulating my escalation rates to see exactly where I would be at the end of the day. So as you can see with the project center, ultimately there are a few things that are very particular to me. My debt service coverage ratio, my debt yield, my cash on cash return, and my total internal rate of return to see if it's a go deal or a no-go deal for me. And I don't have to do any of the calculation myself. So as you can see right here, I've got debt service coverage each year. I've also got my debt yield, which typically at stabilization needs to be above 10%. And then I've got my cash flow before taxes, my principal reduction, before tax cash on cash plus principal reduction, and my cash on cash return. If you scroll over to the right, remember that I put in an exit date, usually 3 to 5 years out, sometimes 7 in the time frame. This actually gives me the opportunity to insert my going out exit internal rate of return estimates. And in here, we've got 7%, 7.25, and 7.5. It then shows me with each column what my internal rate of return would be for each of those cap rates. As you can see here, this deal is pretty skinny at this point in time, so I'll have to go back and manipulate my rent to get these numbers back up so both my cash on cash is higher and my internal rate of return is higher. After I've entered all those data points, then I can go back up to the very top and look at my project summary. What is my investor return versus my sponsor return? In this particular deal, I don't have any investors. It's all equity that we're contributing. So I don't have anything on the top line, but on the bottom line, you'll see my sponsor return is 13.43% internal rate, an equity multiple of 1.77, and a total distribution of $6.2 million. That is a very quick overview of the financial modeling process. I hope you've gained some information. Any questions, be sure and reach out to us.